Welcome to Cycles TV. This session of the Market Cycles Report is intended exclusively to provide information and education to help individuals better understand cycles and the markets. However, this information is not to be construed as professional advice as to the buying and selling of securities. In no event does the host express any opinion with respect to, or make recommendations regarding, the purchase or sale of any particular investment instrument. There is a very high degree of risk involved in trading. Buying or selling decisions are solely within the personal discretion of each individual. And now, enjoy the show. Here is your host.
Welcome to the Foundation for the Study of Cycles. I'm happy to be back again, and thanks for joining me again today. So we had a short break the last 3 weeks. I needed to take a break, summer season here in Europe, so I took the chance to have some time off with my family. But besides that, we are back, we are live, we are Cycles TV from the Foundation for the Study of Cycles. So if you have visited us for the first time, we are meeting here regularly once a week, Monday, same time, same place, and I will review some interesting current market data based on cycle analysis. So the purpose is learn something on cycle analysis while using current market data. That's the purpose of this weekly session, to give you a little bit of ideas, thoughts on current markets using cycle analysis. So what's in the planning for today? During the last weeks, I found an interesting aspect of cycle analysis which I want to share with you today. It's about spread cycles. So it's an interesting use case to apply cycle analysis. So if you are dealing with spreads in the markets, so the difference between two different assets, and you can apply this to various spread data sets, or using two data sets and analyze the spreads, and then we can see if there is a cycle in the spread of the analyzed data set. So depends on which two assets we use for the spread building. So for example, it works in Forex pairs if you analyze the spread between different currencies, and then we specifically want to analyze if there is a cycle. So if the spread is going in cycles. So that's the interesting point on analyzing spread data sets, especially. However, we have a very interesting situation if we're talking about spread in the yield curve right now. And that, I think, is a great point to discuss it here live on the channel. So first of all, what is spread cycle analysis? And second, what's up with the inverted yield curve we currently have in the markets? So what does it tell us? And is there something about cycles in it? So that's the topic I want to share with you today. So that's the one and only subject for this session, 20 minutes. I will review the cycles here to give you an possible idea on cycles in the yield curve. As always, we are live today, so I will monitor the chat section in parallel, and at the end of the session, I will take some time to go over your questions. Not to forget, before I jump into our topic, I hope you are aware of that we have a special event taking place tomorrow. Yes, tomorrow. So we will discuss the situation in gold with various experts. So my colleagues of the Foundation Board, with Peter Eliades, which you know from cycle analysis. We will all have a look at cycles, and we will all be live at the same time tomorrow evening. So depends on your time zone. But for me, it will be the evening. So if you have not heard about this event, maybe head over to cycles.org, reserve your seat, join us tomorrow on the special event on gold. But that's just what's happening at the Foundation to give you the latest update. Now let's talk about yield curve and cycles in the yield curve. First, I have included a link to an article I would recommend if you are not fully sure what we're talking about when I'm talking about the inverted yield curve. So let's go just quickly through the topic. What is an inverted yield curve and why in general? So this is not related to cycles, but why in general this is important to always monitor the situation here. So the link I'm using here is also in the description below. It's an article from the Financial Times, and it's a good one. So it's anyhow a good read. It's from April this year, so it's more or less current. And I will give you quick information. So what's the yield curve? This is what we are all aware of, the basic yield curve. We are all looking to. So on the x-axis, you have the duration, 2 years, 20 years, 30 years. And on the y-axis, you have the percentage of debt you need to pay for the time until the debt matures. So normally, this is how it normally looks. So the longer time frame you choose for your contracts, the higher the debt will be in general. So so if you have very short-term contracts, the yield rate will be lower than if you choose longer-term with Treasury debt curves here. So and now we can build a spread between two different data sets here in that case. And a spread is now, if we take, for example, the 10 years debt or US Treasury yield curve, which is in the normal case, let's say around 4, and then subtract a shorter term yield curve. So for example, we can use the 2 years or 1 years and subtract the amount of the 2 years or 1 year's yield curve, which in general will always be a positive valuation. And we also know that the yield curve will always be, or in normal conditions, will always look like this. So if the spread is going far away from the normal situation, it will revert back to the normal situation. And this is where cycles will become interesting to see if the spread in different contracts now, and if it gets too large, the spread, it will come back to the normal situation. So that's why cycle analysis is interesting to apply on spread. But that's how a normal spread curve looks. What makes the current situation so interesting is the situation that right now it does not look like this way. Yeah. So we don't have a normal yield curve right now in the markets. We have an inverted or negative yield curve right now. So, and this is a leading indicator in general, and especially if we can find cycles which confirm that. And this is where I will come to in a second. So in general, you see here are 3 different yield curves, how they evolved over the past 6 months. So December last year, this is the blue one here, down below. This in December, the yield curve looked quite normal. Yeah, and also in mid last year in December. But now if we jump over to the red one here for April this year, you can see that the yield curve flattens out. Yeah, so there is not much difference between the longer term contracts, between the shorter term contracts. And in general, without referring to cycles, just in general, it tends to flatten when investors expect an economic slowdown or recession. So this is always a leading, interesting point to watch and to talk about spreads. In that case, the blue line here, or the gray one, would also be positive if we subtract from the longer term contract. So the 10-year contract minus the 1-year contract will always be positive. When we get to this flat situation, the spread will become 0 or near 0. And if we have an inverse yield curve, the spread will become below zero, which is a very uncommon situation. So it's completely taken inverse the yield curve. And here you see the spread, what I'm taking in this case. This is the difference between the 2-year and 10-year US Treasury spread. And you see in April last year, this started to go back to zero. Okay, and here you see when it even comes, different. So just recommending this article just to read a little bit of basics about the yield curve. We will use for our example now, I will show you the spread yield curve, the 10-year minus the 1-year spread. And I will give you, the data set, by the way, is also included in the description. So what I'm doing now, you can repeat on your own with the cycle scanner after the analysis. So let's jump to our cycle analyzer. So here's the data set. By the way, this is already a preview of the refreshed user interface. So you can be sure we are working hard in the backend to improve our cycle analysis tools. And there's the big remake around the corner from the user interface. I will now use this as a preview to also give you some insights how the new user interface will look like. So it's a little bit prettified. But back to the topic. So this is the 10-year minus the 1-year Treasury spread. Here you see the zero line. So this is the zero level, and once we drop below this line, we talk about the inverted yield curve, which is a very uncommon situation. This does not happen often. So you see right now, so since April, we really dropped below. We have the negative scenario, and then you can clearly see the individual situations when this happened in the past. So, and this chart is coming from 1970. So we have over 50 to 60 years of history here on this yield curve, which is very nice, this long history. And now to analyze these situations when we dropped below zero. So dropping below zero, inverse yield curve. So we have this right now. We have an inverted yield curve in the markets right now. What does this mean? Let's start with the general topic, which up to now has nothing to do with cycles. So if we just analyze the important points when we dropped below zero, which are indicated here on the chart, if we start here on the left-hand side with the first point here, I will get back to the cycles curve here down below in a second. So this is the point number 1, when we dropped hugely below zero level. And here I have indicated the situations, what happens in the global markets around this time. So here 1973, when this happens, the S&P 500 dropped from 120 here, this level, down to around 60. So a drop of 50%, which is huge. Yeah, and then we can go through the different situations here. Here's the second point where we had the huge drop below zero, and then the S&P did a correction around 30% in the markets. So then the third point can be found here when we dropped hugely below zero. Again, now this is the year of 2000. I think most of us will remember this situation here in the markets. And then the S&P again dropped nearly 50%, closely at the same point in time while we had the inverted spread in the yield curve here. Then we have the next point here, 2007. Yeah, you also will remember the crash which we again had in the S&P 500 here indicated on the top. Again, markets did a correction about 50% in the year of 2007. And now you see both situations have been indicated by an inverted yield curve. And now fast forward to the current situation. Here we are, here you are, we all are today. Yes, let's take a closer look. So, and now the question is, what does it mean? Yeah, I've indicated this here. What does it mean for the global markets? So in general, and this is where the media and the news is talking about this inverted yield curve, you will find a lot of information about this. And now we can apply our cycle analysis to this spread data set. And this is what might give us interesting clues if we can find cycles in this spread rate. So the raw data itself speaks for itself and clearly is a leading indicator. But it will become even more important if we can detect cycles in this spread. So if we will revert back to the normal situation, and if this is the case, what does it mean for the global market? So therefore, let's jump to our cycle analyzer, where we can load this data set. Yeah, I have shown you here the ID of this data set is also linked below. You can put this as ID into the cycle scanner and pull up exactly this data set. So you can now repeat this analysis on your own if you like. And then we need to look on the cycle scanner and the cycles in this data set. So here down below, you see the current cycle analysis. And now I'm using really a very long-term analysis. So I really want to analyze the full data set. In this case, and now we are coming to these special topics on cycle analysis, normally I would not recommend to use such a lengthy data set over 50 years, even going back to 1964. I'm throwing all data in our cycle analyzer here. The reason why I'm doing this is, as we're talking about a spread, this is a detrended data set, so there is no trend in a spread, in general, no trend. So it's like an oscillator going from minus to plus, and if it oscillates in cycles, it's very easy to detect. And that's also a reason if you don't have trending data sets, you can do long-term analysis with lots of data like we have here. So that's maybe also a good learning on cycle analysis. If you have no trends in your data set, which is often the case if you use spreads or spread data sets, then you can use the long-term analysis without taking too much care on the shorter-term period current situation versus long-term cycles. Okay, so this is the spectrum, which gives us clearly the most dominant cycle, about 285 weeks. Yeah, we are talking about a weekly data set here. Yes, it's a weekly data set. And then we will find the other dominant cycles here with 126 weeks. And then we have some shorter term cycles like the 101 weeks. So these are the three key cycles I would select. One reason I select these cycles, I often repeat the reason why to select these cycles here is, first we go with the most prominent or dominant cycle, which is the 285 weeks. It has a green triangle, good battle score, and a very high amplitude is standing out in the spectrum, clearly separated from the other cycles. So this is the number one cycle to go. And then we need to decide which to select from the shorter cycles. And another good measurement is the linear slope you want to have in the difference between amplitude and length. And if you can draw a line between, so this is a harmonic between the amplitude and the length. So that's why I'm, in that case, these three absolutely make sense to use for our composite cycle analysis. I think I have not evolved on this method, how to decide which cycles to use. So to repeat it just shortly, go with the most dominant, with this standard procedure we always use here, the clearest peak which stands out in the spectrum, good battle score, good strength, clear separation of cycles. Then add 2 or 3 or 4 cycles at a maximum to a composite, and a good method is if you can draw a line, yeah, and this line will connect 2 or 3 other cycles. You have an harmonic relation between these cycles, amplitude and length is a good reason to select. So this is what I've done here in that case. So this is a mix of 4 cycles which have been selected here based on this scenario. So we can now hide the spectrum, yeah, to make this chart a little larger, and I will now plot this as an overlay. So this is the and I will also hide the list of cycles here now to make it a little bit clearer. So this is now the cyclic model, yeah, of the spread, let's say from 90, 60 something up to today. So the first thing is you need to spot the correlation between major tops and major bottoms of the cycles with the underlying data set. Here, this top, here, this low. So I will not go over each individual major turning point, but I think it will clearly pop up that this cyclic behavior between the composite cycle model and the raw data set becomes obvious. That is a very high correlation between the composite cycle model and the yield spread we are plotting here. So this is the second very interesting situation. So first, it's always interesting when we have an inverted yield rate out there, which does not happen often. Second, if this spread is heavily correlated to a cyclic model, this makes it really interesting to monitor. So 2 very interesting situations right now. And third, and that is the key reason why I want to share this today, look at where we are today in this cycle here. It shows that this cycle is due to turn right now. I mean, we're talking about a weekly cyclic model, so it's allow some percentage of delay. So we're talking about a 285-week cycle. If you allow a deviation of 2 to 3 weeks, that's almost 0 in regards to the current situation. But the cycles now tell us that we should expect the yield curve to reverse back to normal. Yeah, so we could see a reversal like this, like we had here, like we had here, like we had here. So that's the beauty of cycles. Cycles show us one possible outcome of the future if the cycles repeat. Yeah, that's always the precondition which needs to be met. We don't know yet. We cannot tell this for sure. But that's now the really key point here. The cyclic model on the inverted yield curve for the US Treasury 10-year, 1 year shows us we are on an important turning point, that the inverted yield rate will turn back to normal. So that's the cyclic model here. Please repeat this with your own analysis. And we know from past situations what happened at these points in time. So yeah, I've indicated this here with point number 5. So this is the cyclic model. So I've now plotted the overlay cycle, which I've just shared you in our cycle scanner, just down below the chart as an, yeah, similar to plotting an indicator here down below. So it's the same cyclic model, just plotted here as an indicator. And number 5 as number 4, number 3, number 2, and number 1. The markets always turned when the cyclic model turned, which is indicated for, yeah, the weeks to come. So during the next weeks, if the yield curve gets back to normal, this is the leading indicator that we could see another, and not a small, another big drop in the global markets. So, and this is in alignment with the long-term analysis. You know about the weekly model on the S&P. I've shared the weekly cycles here very often since the end of last year. There is no update. The weekly cycles still point down into a low for beginning of next year, so no change in that. And this now confirms, I don't think we see another bull market, which some call since mid-June a bull market has started. I think we have seen 20% in the Nasdaq. So just theoretically, some could call it another bull market now. But this is not the confirmation about that. This is, be careful out there. So we might see, or we have a very high risk that we can see another drop with a large amount, not a small amount, a large amount. So that's it for today. I wanted to make the point on, first of all, what are spread data sets? So I want to encourage you, think about what spread data sets come to your mind in your asset classes you're dealing with. Search a little bit. Maybe you will find an idea about which spread you could use in your analysis. The yield curve is one. Currency pairs and spreads in currency is another common way to do. Please load this data into the cycle scanner and do cycle analysis. And if you can find cycles and spreads, this is what I'm often talking about. You should not only use the raw data set and analyze cycles in the S&P or the weekly. You need confirming cycles in related data sets, not completely uncorrelated. But the inverted yield curve is not directly correlated to the stock market in general. But there are some special situations which are related to special events which take place afterwards. And cycles can help us to confirm this and then confirm our raw data analysis we did. Okay, so now let's get to your questions in the chat section. Feel free to drop in even more questions. I will now take the time to get into these. So first of all, Elliot, a question. Have we had a bear market rally and is it over now? Yes, so this would, what I showed you right now would confirm exactly what you imply with your question. So, and the longer weekly cycle analysis showed us the same. So the rally we saw from mid-June to August, maybe extending into September, that's not fully clear, is not the start of a new bull market, at least in regards to cycles. Yeah, and the inverted yield curve and cycles confirms that. So yes, I think it was a bear market rally. It is over now. Next week, I will analyze the daily cycles in different global assets. So tomorrow we will have gold. Next week, Monday, I will directly go into daily cycles on the S&P, so we can check this on the daily market. In general, or just a short sneak preview to next Monday, there might be the alternative that we can see a correction also to the upward into September, but latest. So it's not finally clear. Is this the final end, or this is just a dip? Then we might see another upward push into September, but latest. Yeah, it's just an option. So just be careful to speculate on more shots. But in general, Elliot, I would confirm the point you're making here. Okay, so to your follow-up question, yes, that's what we're doing here. And as promised, next week, Monday, we will review daily cycles in main stock market here. So at least we will start with the global S&P and Nasdaq. And let's see if we come to cryptos, but that's what I will promise you for next week, Monday. And I think, Vishal, I think I talked on that. Please show an analysis on daily cycles showing top to form by end September, bi-weekly. Okay, which one to follow is very confusing. So your question is about confusing cycle analysis signals. So this is also what's more or less normal. So we often have the situation there is not only one cycle. You've seen the scanner. The scanner also always shows us a mix of different cycles, which is currently in the markets active. However, no one knows, or at least the cycle analysis does not show us which cycle is the best one in regards giving future predictions. And that's the key point we need to learn. We all need to learn, and there is no simple answer to that. There is no simple algorithm. And therefore, we need to live with the fact that there are confusing cycles in the markets active all the time. So it's not confusing, that's normal. What we need to learn, and that's also a reason why I'm doing these episodes here every week, we need to learn which cycle to pick for our analysis. Detecting cycles is easy. So some will sell you, I don't know what, a cycle detection tool. Cycle detection has been developed in the 1980s, 1990s, all the digital signal processing. It's there. It's easy to use. So the question is not how to detect cycles. The question is, and that's the education, that's the knowledge, which of these 10, 20 cycles which digital signal processing can extract should we use if we want to get a clue of the future? If there would be an easy answer, it would be out there. It is not. So Vishal, sorry for the longer term answer, but what you call confusion is more or less the situation we as cycle analysts have to live with and need to find a way to find the right one. But this is what I try to show you, which cycles to select, give you some reasons which not to select. Okay. Yeah, and I think, Christian, your question goes in the same direction. So can you expand on this and how it relates to the length, amplitude, strength, and Bartels? So choosing the correct cycles is the key in cycle analysis, not detecting cycles, choosing the correct cycles. So I like the point we are coming here now, and how it relates to length, amplitude, strength, Bartels. So first of all, look to the spectrum with the peak in the spectrum with the highest amplitude peak. So a spectrum always shows the power or amplitude. So for the highest peak in the spectrum, this is related to amplitude. And this peak, so the highest amplitude in the spectrum, should be clearly separated to the left and to the right. So if you see a lot of peaks with the same amplitude close together, you can throw away the cycle analysis because you won't get any clue of that. So the first rule is look for the amplitude which stands out in the spectrum and which has a sharp peak, not a flat peak. So the amplitude should get a clear peak, not a flat plateau-like amplitude peak. That's the first rule. Then second, if you find 2 or 3 cycles with great amplitudes which are separated, then divide it by the length score, which gives you the strength. And the strength should be high because this is the rate of change per a data point or per time difference you have. So this is the second reason. Then from the length perspective, I would always start with longer cycles. So in regards to the spectrum, come from the largest position, so on the right-hand side of the spectrum. Start with the longest cycles with the best amplitude standing out because they will show you more the larger swings in your data set. Don't take too much attention to the closer or short-term length cycles. And last but not least, the Bartels score is an additional confirmation in regards to the statistical significance of this cycle. So it gives you an additional measure. If the Bartels score is very high, it's more confirmation that this cycle is repetitive in the data set. If you have a low Bartle score, you are not sure if there are much repetitions in the data, for example. So that's then the final value to look at. So in short terms, I mean, this is just very briefly short summarized. That's the way how to choose the correct cycles from the spectrum, and always try to teach this very objective method. So it's not cherry picking. We have this clear method all together. Christian, I hope it answered your question. If not, please let me know. Okay. So maybe Tony, in relation to what we have discussed here, when yield curve going back to normal, does this mean long-term interest rate need to rise from here to produce a rising curve? Yes, exactly. So I mean that's the if we want the spread coming back to normal, so we'll get back from the inverted to the normal yield curve. This means that the longer term interest rates needs to rise up and be larger than the short term ones. All the short term contracts need to come down. So there's both which need to move to get into this situation. Okay, so back to your point. I read that the lower the Bartle reading, the stronger the cycle. Yeah, that's correct. If you read about the raw Bartle's value comes close to 0, which is strong. In the cycle scanner application, we don't show the mathematical Bartle's value, which is 0.0 blah blah blah, so very small values if it's a strong cycle. We just invert it by 1 minus, so we just go up to, if it's close to 0, it means we get 100%. So 100 is the highest score. From the Bartle's value, it's close to 0. Might be a little bit confusing, but the higher the Bartle's score, which is 100%, which is just 1 minus the Bartle's value. So in theory, for sure, if you follow the theory of Bartle's, the Bartle's value needs to come close to 0. We are showing here the Bartle's score, which is about 1 minus, so therefore we show a different value. And therefore also the color coding is in regards to the Bartle score. So green is highest Bartle score, above 70, 80, so which means very low Bartle's values. So you're absolutely right. Very low Bartle's values will give a Bartle score about 70, which will give us a green triangle. And red triangles will have low Bartle score, so I think below 30. Which would have a very large raw Bartle's value. I hope I don't confuse you all, but Christian, your question is on the point. Just to explain how it is shown here. Okay, so maybe some other topics here. Vishal. I think one can link the Elliott wave with time cycles. It gives good signals. Yes, sure. And I find it very complicated. So Elliott wave analysis on its own is not easy because it's always a little bit subjective. What pattern are we in right now? Yeah, from counting the Elliott wave patterns, and therefore the cycle analysis can give clues to the Elliott wave analysis when some Elliott wave patterns might to fit into the markets. And when you get a conjunction, so Elliott wave also gives us some price targets, or at least ranges of price targets here. And if these price targets are then achieved in different cycle time projections, you have confirmation between Elliott wave patterns, cycle analysis. Therefore, these two, I think, complement each other. Okay, so maybe One final topic here. You know, we have the basic and the analyst subscription for our cycle analyzer. In short, if you're only interested in daily cycles, you're not dealing about intraday, and you don't want to upload your own intraday data set, then the basic one is more or less what you need. You can analyze basic cycles. You can save up to 5 uploaded data sets. You can configure that, and you're good to go. The analyst subscription offers first the opportunity to also upload intraday data sets. So if you're interested in 20 minutes, 5 minutes, 1 hour cycles, then you need to have the analyst subscription. The analyst subscription has also increased values of how many data sets you can upload, you can save, and you can even configure more complex market analyst scenarios. So there's more flexibility in how to use the scanner, and 2 or 3 special features. For example, the harmonic analysis is related then to the analyst model, and some energy models we provide. So some special features for the analyst. So just in short, but I need to make a longer video, especially on that topic. So I think I would call it a day. At least for me, it's anyhow. Now we are getting close to evening time. So I'm really happy to be here again with you every week, again and again. Tomorrow we have the a gold roundtable, and next week, Monday, we will have the daily cycle analysis. Please join me live every week, Monday here, because I like your questions. I like the discussion. That's also the main purpose why I'm here. And maybe that's the headline for today. It's not about detecting cycles. It's about choosing the right cycle for projections. So let's meet here again next week, next Monday. Thank you. Have a nice week. See you again next Monday. Bye.